The stock market is being shaken by the US debt crisis. So let's start with this. Last week, the United States credit rating was downgraded by Moody's. So essentially, this means that the US has lost its perfect credit rating. So there are three major credit rating agencies. There's Standard & Poor's, and they downgraded the US, and this is back in 2011. Fitch Ratings, they downgraded the US in 2023. So that means that the government's going to borrow another $2 trillion more, and that's $2 trillion more towards the national debts. So already, in the first 6 months of the fiscal year, the deficit has grown to $1.3 trillion. So the government needs to borrow $9 trillion on top of the $2 trillion deficits. So that's a lot of money that they're going to have to borrow this year. So yes, it was a bad attitude, overconfidence, and a flop. People were not lining up to lend money to the US government, no. And if more money flows to stocks, then the stock market's going to go up. But if Treasury bonds are paying 7%, 8%, 9%, 10%, then in that case, why would you invest in stocks? Why would you take the risk in the stock market? You could just lend money to the US government risk-free and earn 10%. And that would mean fewer investors investing in stocks, which would hurt the stock markets. So high interest rates are a problem for the stock market.